I'm John Bollinger. I'm probably best known for creating something called the Bollinger Bands. Thank you. I've never gotten applause for the bands before. That's pretty awesome. Unfortunately, it's not the bands that I'm going to talk about today. Wow. Would there be a lynching afterwards? Is that when I first came into this business, it was a different environment. It was the very early 1980s. I shifted to the investment business full-time 1980, 81. And in those days, it was quite a different environment. We had swing traders then, but they weren't swing traders as we know them today. Guys who were in the market for 5 minutes, 10 minutes, half an hour. If it's a really long-term trade, it takes a day. In those days, swing traders were people who looked at daily and weekly charts, and we tried to capture moves that ran 20, 30, 40% in a stock and may run from a period at the very shortest of some days or weeks, maybe into 2 or 3, 4 months, and at the longest out to someplace between 6 months and a year. And we called ourselves swing traders because if you looked at the weekly charts, we got them in book form in those days, or we kept them by hand. You'd see they were the big swings that you would see on the chart. You'd see a consolidation zone. You get a big expansion, another consolidation zone, maybe a big decline in swing. We were interested in those big swings on the charts. And we had a whole bunch of tools and ways of trading them. We used trading bands a lot. This was the environment in which I developed Bollinger Bands ultimately. But one of the things we traded stocks. That's about all we traded, because the rest of the stuff didn't really exist yet. There were, shortly after I started in the business, we got the very first stock index future. Was the value line, traded in Kansas City. Shortly after that, we got the S&P futures. But index trading the market as a whole, just wasn't a big piece of the puzzle yet. We were interested in individual stocks, and there were a list of the high flyers, the stocks that really moved around a lot. It had a lot of opportunities, and those were the stocks that we focused on. Some of you will remember them. Teledyne, TDY, Humana, HUM, ASA, which was gold stock, ASA. They could go on and on and on. But these were the sorts of opportunities we focused on. And very early on in the game, you learned that if you were going to be successful in that environment, you had to be right not only on the stock, but you had to be right on the industry group as well, and you had to be right on the market sector. And you had to have some opinion about the market itself. So it wasn't that we traded in a vacuum, just trading the single stock. But we looked at these other factors and added them to our analysis, and we found that when we did so, we could improve our risk-reward relationships. The key then, early on, was getting the industry group right. And that's really what we focused on more than anything else, because sectors weren't that readily available. I was very lucky. As soon as I got involved in the market, I got access to what was called the Merlin system. It was spelled Merlin like the name magician, but it was really an acronym for Merrill Lynch. And it was a computerized market analysis system that ran on mainframe computers, and you accessed it through a dumb terminal. It was really the first full-on technical analysis software. And on that system was a little report that categorized the S&P industry groups, the industry groups that form the S&P 500, by their deviation from an average, how far above an average they were or how far below the average they were. So it was a very simple momentum analysis of industry groups. And if we wanted to buy a stock, the first thing we checked to see whether the industry group was rising as well. Later on, we also got access to information about the market sector, so we could add that into the puzzle. And we also had market timing information as well. That was an important piece of the puzzle. That was the environment in which I learned, and I have kept up my love for this type of analysis ever since. So today, when I find an opportunity to trade, usually using Bollinger Bands and the related tools, percent B and bandwidth, the first thing I do is check to see that the industry group is in sync with my opinion about the stock. And if it's not, I simply don't take the trade. I'll look around for another opportunity. There's some 5,000 stocks out there that are easy to trade, another 10,000 more than that that are a little bit harder to trade, some of them impossible to trade, in fact. So there's a plethora of opportunities. And unless I can get everything just the way I want it, the stock, the group, the sector, market, all lined up together, I just don't bother to take the trade. I like to think about it this way. This is a picture of a coxswain on the left and 4 rowers rowing the coxswain along. So I like to think of myself as the coxswain being rowed down the river, or in this case it happens to be a lake, by these rowers. And one is the stock, one is the industry group, one is the sector, the broad economic sector, and one is the market itself. And when all these rowers are pulling together, I have a fairly nice ride. I mean, I move along smoothly and at good speed in a way that is very conducive to making profits. But what happens if one of these rowers lifts their oar up out of the water and stops rowing? Well, the boat will veer sharply to the side that the rower has lifted his oar from. Then if a rower on the other side lifts the oar, the boat will straighten out again, and you'll at least be going in the right direction, but you won't be going there very fast. Your overall speed will be reduced. And if you have just one oar in the water, you're just going to go around in a circle, right? Just endlessly in a circle. So I really feel that all the parts and pieces need to be in place in order for this to work.